I think March is going to likely be an up month. I know it doesn't feel like that because of the way the end of February felt. But
comes in like a bear, goes out like a bull.
Yeah, it probably comes in with the better weather. But the things like software, the Mag 7, and the crypto all had early weakness. They're all probably in the final stages or have already bottomed. And I think that helps lead us up to an up April.
So when I say nothing stops this train, there's actually two sides of it. One is basically the argument that they, despite multiple attempts, they will not materially and persistently reduce the fiscal deficit. So that's one side of it. Mm-hmm. The other side is kind of the other, which is to say, it's also not going to blow up anytime soon, right? So it's not like it's going to spiral into disaster anytime soon. Basically, that the wheels are going to stay on the track, so to speak. That there is a lot of highway ahead, whichever kind of description you want to use.
Markets are starting to price in a more orderly finish to the first quarter, despite the shaky and risk-off end of February. Tom Lee asserts that March is still likely to be an up month, arguing that the early weakness in software names, the Magnificent Seven, and crypto may already be in the final stages of a bottoming process. That setup, he suggests, sets the stage for a stronger April rather than a deeper pullback. Similarly, Lyn Alden builds on this by describing what she calls the nothing stops this train dynamic. Fiscal deficits are not likely to be materially or persistently reduced anytime soon, yet the system is not on the brink of a near-term apocalypse either. Instead, she sees the train staying on the tracks for some time, with a lot of runway ahead, rather than a sudden derailment. Bitcoin's price has been moving in sync with this risk-on narrative. As of early March 2026, it is trading just under $69,000 after briefly dipping below $62,000 on geopolitical noise. Spot ETF flows have turned positive again, and on-chain data show that large holders are treating the current range as an accumulation zone rather than a reason to panic. But what Tom Lee just said about the market might matter far beyond the next few weeks of price action. According to him, what we may be witnessing right now isn't the start of a deeper correction. It's the market quietly resetting itself before the next leg higher. Let's go back to his interview with CNBC. Please don't miss out on future exclusive content, like subscribe to our channel and enable post notifications. Thanks for joining us again. Enjoy the video.
I mean, nobody likes to see headlines and the images of explosions and war. And so we know risk premium jumps. That's why the VIX jumps. But it's not really going to change the fundamentals of the U.S. So in the past, markets kind of sell off into the buildup, and then they tend to do better once the battle begins. And I think this is going to be similar.
We got to watch across the board, obviously, gold and the yield curve, but as in oil, obviously oil, it won't affect us in the economy at this point, but I guess there's a scenario where down the road it could, isn't there?
Yeah, I mean, I think a lot of experts are going to worry that this could, encompass a larger conflict, something that would be, World War III or something.
Right.
But in the absence of that, I think the worst of the sell-off is going to happen this week. And, I would expect actually March to be an up month for the stock market. Oil is going to create a price shock because oil, it ends up so much in the economic supply chain.
Even what we produce here is going for 72 now, so it doesn't matter whether, we got plenty of it, but oil companies are obviously going to reap some benefits, but consumers, this will filter through in a time when we're still inflation phobic, I think.
That's right. In the past, oil shocks are actually more at risk of maybe tipping a weak economy into recession.
And that's not where we are.
Yeah, and so I think instead of thinking the Fed would be hawkish, I think the Fed might be dovish on a spike in oil. I mean, I know many companies that are rolling out AI workers. Even at Fundstrat, we are deploying these agents and, treating them as if they're employees. But I think we're still unsure whether or not this will ultimately create more jobs or not.
And AI is killing will kill a lot of companies. And AI itself, the killer is, you could say, had such a run that it is at least richly valued.
Yeah. And, at least in the case of the software stocks broadly, the entire complex kind of has fallen back to where they were last April. To me, that's clearly an overreaction. So I think it makes sense that you'd start to see some of the groups that got hit hard mean revert, including the Mag 7.
So you think we're getting to the point now where the initial weakness you saw in the markets, we're making a bottom at some point? What do you say will be up for March?
Yeah, I think March is going to likely be an up month. I know it doesn't feel like that because of the way the end of February felt. But
comes in like a bear, goes out like a bull.
Yeah, it probably comes in with the better weather. But, the things like software, the Mag 7, and the crypto all had early weakness. They're all probably in the final stages or have already bottomed. And I think that helps lead us up to an up April.
Have you woken up in the middle of the night and looked at where Ethereum is and said, I can't go back to sleep?
No.
Yeah, not worried yet?
No, because, Ethereum, there's the fundamentals, like what's happening. So much is being built on Ethereum now. I mean, almost every major announcement of a tokenized fund is being built on Ethereum. Does that
translate to supply and demand dynamics that make the price go up, though? Or can you just keep building out all these networks at 1900?
I mean, that would be like someone saying all this activity is happening in the United States, but the economy shouldn't boom, Yeah. So if it's all taking place on Ethereum, then price follows. But we are in a crypto winter, so price doesn't matter. Capital is looking at gold and silver and ways of, hard assets. But that isn't always going to be the case.
I'd read you buying more Ethereum on the dip. How much more? And does that continue today?
Yes. So Bitmain's been buying about $50,000 or about $100 million of Ethereum every week, but the cash balance has grown to over 800 million. So it's able to, at the right moment, make a major buy of Ethereum. So I think we're getting ready for the crypto bottom. But we're still buying about 100 million a week.
It won't really alter U.S. fundamentals. Markets typically sell off leading into conflicts, then rebound once fighting starts, and this time should follow suit. Keep an eye on gold, the yield curve, and especially oil, which won't hit the U.S. economy hard right now, but could spark bigger issues down the line if tensions widen into a broader clash. Without that dire scenario, expect the worst sell-off this week, with March turning positive for stocks. Oil creates price shocks, since it's woven deep into supply chains. Even U.S. production at $72 a barrel means oil companies gain, while consumers feel the pinch amid inflation fears. Past oil spikes risked tipping weak economies into recession, but we're not there now, so the Fed might pivot dovish instead of hawkish. AI has crushed some firms and feels richly valued after its run, yet software stocks have reset to April levels, an overreaction ripe for mean reversion. Waking up to Ethereum at current prices? No panic. Fundamentals shine with massive builds like tokenized funds happening on it. That activity should boost supply, demand, and price, much like U.S. bustle fuels economic growth. Crypto winter diverts capital to gold or hard assets for now, but not forever. Now, let's turn our attention to Lyn Alden.
One of the factors is if you look at GDP growth, one of the inputs is the deficit, basically overall spending matters. So you almost get like a feedback loop there. In general, the nothing stops us trading thesis, basically the more productivity growth there is, the more offsets there are to the money printing, the longer it goes. So when I say nothing stops us trading, there's actually two sides of it. One is basically the argument that they, despite multiple attempts, they will not materially and persistently reduce the fiscal deficit. So that's one side of it. The other side is kind of the other, which is to say it's also not going to blow up anytime soon, right? So it's not like it's going to spiral into disaster anytime soon. Basically, that the wheels are going to stay on the track, so to speak. That there is a lot of highway ahead, whichever kind of description you want to use. And so neither to the bull side, which is basically the Goldilocks scenario where they manage to get deficits down, or to the bear side that we just hyperinflate next year or something, is basically saying that those are both very low probability outcomes in any sort of investable time horizon, 3, 5, 7, 10 years, and that therefore we're stuck in this kind of middle gray zone of large deficits, but the system continuing to run. And the overall kind of inflation calculation, price inflation, it's obviously we've talked about this before, and your other guests have. It's a very messy calculation. There's all sorts of factors and variables that go into it. But when it's putting aside the measurement artifacts, basically what price inflation is you have, at least in the modern era, you have money supply growth. So over the long term, it might be 7% per year in a developed country. And then you have productivity growth, which is lumpy, and it doesn't affect all things equally. But over time, and we have billions of people working, we have technology getting better, we are better at organizing and doing things in the world. So that all else being equal, many things get cheaper in that kind of economic sense. But then it's offset by the money printing. So if on average, the 7% money growth, but we get 4% better every year at making the average thing, quote unquote, then the net price inflation is something like 3%. Although, of course, it's very uneven. And I think that's the trend that's going to continue for quite a while.
In your reminders that nothing stops this train, you're not saying, hey, there's no track out sign coming anytime soon that you see right now.
Yes, basically yes. The caveat there, the really big caveat, is that it doesn't mean it's without problems or consequences during that time. So people often ask, when will the deficit matter? I've been arguing it's already mattering. So literally since the late 2010s, I've been talking about how this will contribute to a period of ongoing political polarization. And that's only gotten more and more noticeable over time. And it contributes to things like the K-shaped economy or the two-speed economy, different words to describe it. If it was as simple as, say, rich people on one side and not rich people on the other side, we could say it's 100, it's caused by that. There's obviously there's a multitude of factors in there. They go back all the way to the fourth turning type stuff too. So some of it's not economic. Some of it is just that we built institutions that last for, maybe a human lifetime, and then they suffer from internal entropy, corruption. We lose faith in them. Generally, there has to be some sort of kind of death and rebirth cycle, or at least partial death and partial birth that we haven't really gone through yet. So we have very little trust in institutions. There's technology disruptions on the way we do things. There's trade imbalances that have been building for decades that myself and Luke Groban and others prioritize quite a bit in our discussions. There's multiple other imbalances there. The fiscal deficit is one of the larger ones, but it's by no means the biggest. But generally speaking, whenever, not just this one, but in any history, when you have fiscal dominance, when the sovereign itself is kind of like long-term structurally insolvent without basically monetizing its own debt to varying degrees, that doesn't go lightly, right? The state doesn't just say, "Well, we just got to let it run out." I mean, that's when the state gets kind of aggressive. Then people get aggressive about what the problem is, whose fault is it? So it's one big variable among a mix of variables.
What should the country turn to as a better alternative to the current fiat dollar?
It's a good question. I mean, in the long run, it ideally would be tied to a neutral reserve asset. So historically, that's gold, and gold's still the only one big enough. Potentially in the future, something like Bitcoin, but it's currently nowhere near big enough. So the best you can do is accumulate some, should that ever become big enough to be something you could attach it to. I think, moreover, it would be about you could also put limits on the growth of the base money supply, that are, depending on how soundly you do it. You could do it in law, or you could literally do it in the Constitution if you want to go to the bedrock and say,
just saying that money supply is not allowed to increase by a certain percentage.
Yeah. Yep. Yeah, you could do that, and that's another way. You still have this kind of unbased ledger, but you have limits on it. Now, in practice, and here's another just painful part. Part of the nothing stops this train thesis is we're already insolvent. We can't realistically get out of this without a default, which is to say there's a certain amount of base money, and then there's all these IOUs built on top of it, and those IOUs are multiple times the base money supply. And the problem is you can't go to hard money when you have that crazy IOU base money mismatch. And if you default, the problem is that the whole system's circular. So someone's liability is someone else's asset. So for example, treasuries, they're over the long arc of time, they're functionally insolvent, but they are the bedrock asset for the Fed, the commercial banking system, many retirement portfolios, insurance company portfolios. So all the things you think are like valuable that you own are tied to the treasuries not defaulting in mass. And the way that sovereigns usually default, quote unquote default, is they debase. So they say, okay, everybody gets their units, but there's way more units now.
Yeah. You meet it nominally, but you just kill the purchasing power of the currency.
Yes. And then the question is, so do you let that kind of bleed out slowly, or I mean, the least messy way to do it was kind of what they did after World War II. I mean, during World War II, they printed all this money, but then they pivoted hard. They had more austerity afterwards. So there was a massive devaluation, but then they had built all these factories. They money printing tried to go more toward the bottom and middle. So like soldiers returning from war, it's like, okay, here's your mortgage support, and here, we're doing all this. Aside of that, it's like pretty significant austerity. So you don't reduce the debt, but you stop adding to it, and you've already debased a lot of it, and then you kind of grow out of it. Now, of course, back then they had way better demographics and other factors, so it's much harder today. Um, but basically, it's okay. It's saying we're already insolvent. So do you want to just kind of like default in a disorderly way over the next 5, 10, 15, 20 years? Or do you want to make a couple clean, painful decisions? Rebalance Social Security, for example, because that goes insolvent in the 2030s. And also, I mean, want to fix the food system, right? And because the healthcare expenses are such a gigantic chunk of the budget. So you look at Japan, for example, they have much lower healthcare costs, even though they're on average 10 years older and they live longer, right? So we have a very specific problem here in the US with our healthcare costs. And a big chunk of it is our food patterns.
According to Alden, GDP growth ties closely to deficits and overall spending, creating a feedback loop. She argues the "nothing stops this train" idea holds because higher productivity growth offsets money printing, stretching out the current path. Neither bullish deficit cuts nor bearish hyperinflation seem likely in the next 3 to 10 years. Instead, large deficits persist in this gray zone while the system chugs along. Price inflation, she notes, is a messy mix. Modern economies see about 7% annual money supply growth in developed nations, offset by lumpy productivity gains from billions of workers, advancing tech, and better organization, making many goods cheaper over time. If productivity improves 4% yearly on average, net inflation lands around 3%, though unevenly distributed, and this trend should continue. Alden stresses no derailment looms soon, but caveats abound. Deficits already matter, fueling political polarization since the late 2000s and a K-shaped economy. Bifurcation contributes alongside other factors like institutional entropy, lost trust, tech disruptions, trade imbalances, and fiscal dominance, where sovereigns monetize structurally insolvent debt, sparking aggression over blame. History shows states don't let such imbalances run unchecked lightly. As a fiat dollar alternative, she suggests tying it long-term to a neutral reserve like gold, the only asset big enough now, though Bitcoin could grow into that role, or capping base money supply growth via law or constitution. Yet insolvency complicates this. How are you positioning your portfolio right now? Leaning into this risk-on setup in stocks and crypto, or staying more defensive in case that "nothing stops this train" narrative turns out to be riskier than it looks? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching. Don't forget to like and subscribe.